Hello and welcome back everyone. It's been a few weeks since our last video. Need to dust off the covers and see what options we can get back into us. So let's get right to it. So here we are in Ameritrade's Thinkorswim platform. We're logged into our paper trading account, and it's been a little while since I've created another video. It's been almost a month, it looks like. So the last time we were running options, we had sold this put back on April 3rd, and we sold it. It was a $43 put, and we sold it we got $97 for it. It did get assigned. We can see that right here in the account statement. Here it got assigned on April 7th, so we ended up buying $4,300 worth of shares, 100 shares at $43 a piece. So let's go over to the web application and clear that off, account for it, and see where we stand. Alright, so here we are on the website, myatmm.com. We want to go over to the cost basis screen. Going to filter down by only positions. We only are running Marvell. So originally we had 400 shares and we had 100 shares secured with puts, or a put contract, sorry. Alright, so we did have a call, and it expired on the 14th of April, and it expired worthless. So let's go ahead and clear that off and get rid of it. And we did have a put on the board, and this one got assigned when it expired, as we saw back on the Ameritrade's screen. So what we want to do is click this drop down. We want to click assign because we were assigned on it, and let's go find out what that date was. So back here on the Ameritrade's screen, we were assigned, it looks like, on April 7th. Okay, all right, so April 7th is what we want to log in the web application. Alright, so on the web application, the assignment date, we're going to go ahead and select the 7th. It was a stock assignment, 100 shares, and the assignment price was 43 because that was the contract strike price. Alright, we're going to go ahead and click submit, and that will, what that did is it added another record here, right here at the bottom. You can see the $4,300. So this put is done. We can go ahead and clear that off. But it should have added a transaction. Okay, it didn't add it here. We have to click save one more time to get that proposed record to generate for us. And so there it is. And again, this is the demo account, so we're not tracking any commissions or fees. Granted, for a stock purchase, I believe in Ameritrade that's free to do. So it's straight up going to be the 4,300. Let's go ahead and click this helper button to move the record down to prepare it to be added to the transaction history. Go ahead and click save, and now that record has been retained, or that transaction has been retained in the transaction history down here. So if we scroll up to the top, we can assess and see where we're at with this stock. So we own the 500 shares. We're in it. It had cost us $22,200 total to get into this position so far. Based off the current value, the current trading stock price, our stock value is $19,740, so we have an unrealized loss of $24.60. However, during this time frame, we have collected $2,949 in premium so far in the stock. So, I mean, $29.49 minus that, so we're still actually ahead about $500. But we're ahead $500. And we own 500 shares of the stock. And I believe this is a dividend-paying stock, so we will collect dividends no matter where the price goes on this. So, okay. So our cost basis is $44.40. Our cost basis with premium, like if you include the premium that we've collected this entire time, our cost basis there is $38.50, which is below where it's trading at. So, like I said before, we are overall positive for this stock currently. All right, and we're not running any puts, so that cost basis is the same. Okay, so since our cost basis is $44.40, we will be looking to trade some call options, 5 to be exact, because we have 500 shares of at least $44.50, which will get us out break even. But if you think about it, if we sold 500 shares at $44.50, we'd be ahead 10 cents on each of those shares, but in addition, we would have pocketed that the entire time. So we would have broken even on the stock, but we would have been ahead $3,000 in premium that we've collected this entire time. So that's what we like to do. We like to target the cost basis. But since it's trading down at 39.40, we're probably gonna have to go out a little ways, at least a month or two, to collect any amount of premium. And due to the fact that I am distracted, or this other project is consuming the majority of my time, what I'm gonna plan on doing is I'm gonna run a call option out however far I need to go in order to collect some decent premium. I'm thinking at least $100 per contract. And then instead of running a weekly put, I'm actually going to run that put, that one put contract, because you know how I like to play both sides. I'm going to put that out there at that same expiration, which means we should be collecting quite a bit more than we normally collect. Granted, if you break it out on a weekly basis, overall we are collecting less as far as a per week premium collection. But due to the fact that I can't monitor this every single week, that's something else that you can do, and you can do in your own trading, strategy. You don't have to do the weeklies. You can sell puts out. I think you can sell even leaps like a year out. So it's just based off of what you like to do, and your current life circumstance. So my current life circumstance dictates that I need to just run these out a little further in time, because I don't have as much time to commit to them, to watch them on a weekly basis. The monthlies seem to be, more convenient for me. All right, so 44.50 is where we're looking. Considering it's out further, we might have to go to 45. We will see. Let's jump over to Ameritrade and find out. All right, so here we are again on Ameritrade's Thinkorswim platform, logged into the paper trading account. What we want to do is we want to click on the Analyze tab, make sure Marvell is selected right here, which it is. All right, and I already got the strike price set to 45 because apparently that's the last thing I was looking for in this paper trading account. So let's just see what we got here. So let's go ahead and start expanding these. We'll expand like 4 or 5, and I'll probably take it out. You can see these are the weeklies, and there's one of the monthlies, and then here's the next monthly. So I'm going to go ahead and go out to show the second monthly. All right, so we're looking for calls first. Normally I look at selling the put because it's usually the easiest one, but considering we're going to time the expirations around at the same expiration, I'm going to go ahead and look for the call first. All right, so we can see this coming Friday, which is only 5 days away, for a $45 strike price, is only selling for 3 cents. So that's $3 per contract. Not much. There's one for 11, and actually this is the bid and ask, so it actually is going to be the difference between the two. So 8 to 3, the spread is 3 cents. So that means you could probably only get 9 cents or $9. So let's start looking at the bid side here. So bid $16, $25, $43, $70, $90. Considering this is only 40 and that's 47, so that's like two monthlies away. I'm probably going to stick with the monthlies. The monthlies are, generally higher volume on those. They're more active, but it doesn't really matter on a highly traded stock. You could trade the weeklies as well, but that's a $20 more jump. In fact, if you look at these, that not quite double, but 40, not quite double. 40 to 70 is not quite double, but that's 20 cents. So I don't know. What's the next monthly? Just curious. Granted, that's 47 days, and that's, what is that? It's like almost 60 days longer. So it almost doubles in price because it's only almost 60 days longer. That's about double the time frame. So I'm not going to go out that far. I'm going to stick with this one, I believe. So 47 days out. All right, so what we want to do is we want to left click on the bid here, and that will put the transaction down here. But we have 500 shares, so we need to run 5 contracts of this, and the spread is 90 to 95, so that's a nickel, so we should be able to get 2 pennies more. So let's move that up to 92 cents. We are going to right click, confirm and send, and that should bring in about $450 in premium. That sounds good. And keep in mind, if in 47 days the price does go up to 45 and it exceeds it and we get called out, we will have gotten out of the stocks at break even, a little bit over, because again, remember, we're at 44.40, so this is actually selling for 60 cents more than we're into it for. So that's a 60-cent capital gain on that stock per share. All right, so I like the way that is looking. So let's go ahead and click send, and that one will be queued. And then we want to look for the put. And again, we're going to be running the put at this same expiration just because since I don't have much time to monitor it, I want to go ahead and put that out there to collect as much premium as possible since I'm not going to be able to monitor it so closely. All right. Current trading is $39.48, so that means we're going to be looking to sell a put probably around $39. So let's go ahead and adjust this filter so we're not like overloaded with a bunch of different strikes. Let's just run it at $38.50. And we'll go ahead and go up to $39.50, so we'll actually get the one right above it too. All right, so now this is showing $38.50 to $39.50 strikes. We are looking for a put, and we usually like to run puts at the money, which in this particular circumstances, at the money is $39, just below where the trading price is. And the last was $39.48, so that means 39 is at the money. And again, we normally do this first one, typically, if we have time to monitor it weekly and we can see where it's going. But considering we don't want to worry about that, we're going to go out to the monthly. Now, here we go. Notice how when I expand this, see, these two are actually expanded if you look at the arrow, but there's nothing showing. The reason why nothing is showing is because this particular strike range is not available 47 days out. So we actually need to make this a little bit wider. So 37.50 does get something to show. 37.50 is showing. So let's do this. Let's do 35, and we'll actually go up to 40. Usually whole numbers in $5 increments definitely generally show further out in time. As it gets closer to expiration, more strike prices become available, generally speaking. All right, so this is 5 days out. We're not going to be concerned with that. Let's go and collapse 12. We want to focus on just getting closer to where our expiration is on our calls, our call contracts. All right, so here we are. Notice how it's a $37.50. So $37.50 is a good $2. Yeah, that's pretty much $2 lower than where it's trading now, and we're still able to collect $186 on that. Okay, let me just look here a little bit closer. Now, see this one going out 110 days? We definitely don't want to go out that far, even though it looks like you could gain another $100. But we're going to go and collapse that one because that's too far out. There's no reason to go that far out, for us in this particular circumstance, because like I said, we're trying to target where we're selling the covered calls at. So it looks like we're going to be trading a $37.50 put out 47 days for $186, and $37.50 over here is $146. But we could trade now see, look at this, 40 days out, we could trade a 39, which is closer to at the money of where it's currently trading at, for $222. But I kind of like keeping it the same as this because we're getting a full $2 discount, so that's another $200 down. If it came down to $37.50, we would actually be saving ourselves $200. Plus, we're getting this $186, as opposed to if we did the $222. If it came down to $37.50, we would. Anyway, I mean, you can do the math. So I'm thinking $186 to keep it simple. Keep it simple. Stay with the same covered calls. $37.50. That feels like a really safer thing to do. So we're going to go and run with that. So I'm going to left click on the bid column for the 186. That'll put it down here. We're only doing one contract. The spread is 186 to 190, so that's 4 cents. So the difference, divide that by 2, you should be able to come up 2 pennies. We're going to right click and then left click confirm and send. We should be pulling at about 187. We're going to go ahead and queue that and click send. All right. So we have these 2 orders queued up, and you can't see the covered calls because the strike price isn't filtered down. You can always come up here and just reset this, and then the filter goes away and it shows you however many strikes you have showing here. But as you can tell, so yeah, the 45 is showing here, and yeah, all right, good. So we got the covered call showing for 45 and the put queued showing for 37.50. All right, so now we need to just sit back, wait for tomorrow morning for the market to open, make sure that these execute. If they don't, we might have to adjust the premium that we're looking to get them to execute. But I'm thinking they're far out enough. I'm thinking they might just go ahead and execute. They won't fluctuate as much as weeklies, like weeklies 5 days out, they fluctuate a lot more at a much faster pace, whereas further out, 47 days out, number doesn't fly around too much, um, being that far out. The ones that are even further out adjust even slower than that. So in any case, yeah, we'll wait till tomorrow, see what it does, and we will follow up at that point. Here we are on the following Monday, logged into Ameritrade's Thinkorswim platform. Again, we're logged into the paper trading account, and as you can see, we now have some active positions for the calls and the puts, or the calls and the put that we had placed the order for. We did have to adjust the put slightly to get it filled this morning. So let's go over and look at the account statement to see how those transactions went. So let's go over to the monitor tab, and we need to filter down by the IRA. So now we got the transactions showing, and we need to shorten this a little bit so we can get less on the screen. All right, so here they are, the two transactions that happened this morning. So one happened at 8:31, a minute after the market opened. That's when our covered call contracts got executed for $475. And as you can see, about a little less than an hour after the market opened, we had to adjust our put to get it filled at $1.73. It looks like, yeah, $173. So as you can see, let's see what we placed the order for originally. So this one was canceled. So we had originally placed the order for 188, and we had to adjust it, and got filled at $1.73 that you can see right here. So what we need to do right now is go over to the web application and track these transactions. So let's go do that right now. So here we are on the web application, myatwm.com. We just got logged in, so it went to the dashboard first. We need to go over to the cost basis screen and go and filter down by our positions, which Marvell is the only one that we have a position in currently. All right, and we need to put 2 new positions on the board, so let's go ahead and put those in the draft spots. And right now we have no puts and no calls. So today, they were open today. They're both sell to opens. We have the calls, and we have the one put that we did. So there was one put contract, and we had five call contracts, and the expiration for them were both June 16th. So let's go and set that up, June 16th. All right, and the strike price for the calls were set at 45, and the price that we got for each one was 92 cents, which is the 460, and that's not quite right. Wait, what happened? So 92, okay, yeah, we had originally placed the order for 92, but they actually got filled at 95. So that's where the 475 came from. And before we click save, I just want to fill out the put side. So the put contract, the put strike was $37.50, and the price we received for those was $1.73, or $173 for the whole contract. So we're going to click save on the call, and it's going to move from the draft down into the call group, and then we'll click save on the put, and it'll move down to the put contract. So here we go. Click save, and you'll see that move down to the calls. Click save on the put, and now that's retained in the puts. And when we did that, it moved down the proposed records down here. Since this is the demo account, we're not tracking any of commissions. Otherwise, we'd enter them right here. And then we click this little helper button to move the transaction down. Click save to retain it. And do the same thing for the put contract. And now both of those transactions are logged. And if we scroll back up at the top, we can see that our previously, I think it was setting just under 3, like at 2,900 or so. And now you can see the total premium collected is now up to $35.97. And yeah, yesterday the price was showing like $39 or something, if I remember correctly, $39.40. And it looks like the stock price has gone up today because it closed at $40.01. So as you can see, our current unrealized loss is $21.95, but our overall gain, or overall premium that we've collected so far, is $35.97. So that's a difference of, I don't know, $1,400, $1,300, something like that. So we're still doing pretty good on this position. And yeah, so we have now to June 16th to wait. And like I said, I am involved in this other project, so that gives us a good amount of time to wait to see how these play out. And generally, you'd watch these to see how much extrinsic value is left in them. And if the extrinsic value drops really low and they're not in the money, you could probably go ahead and close them to secure, whatever profit you've made up until that point. And if they become in the money, then this demo account, we're just going to let them play out and expire in the money, and we'll just either get called out or we'll end up buying some more shares. But, in real life, you could choose to roll it and continually roll it so you never get assigned, or, whatever you choose to do. We're going to jump over to the dashboard because I want to see what the total premium collected month to month has been for this entire year, because we're now in the month of May. All right, so premiums tab. So in December we collected $13.51, January $4.94, February $13.79, $7.37. So we're jumping up and down and all around apparently. And May, just one day into May, because today we collected a bunch, so $648. However, like I said before, the expiration isn't until June, so that's pretty much all we're going to collect for this month. And next month, we'll move on. But, by the end of the year, we could probably start throwing up some percentages of just how much money we've had involved in this, but how much money, we've made each month to get, our return on investment of how much we've made, on average each month. I know the projection screen does show a little bit of that. And based off the numbers so far, it looks like our ROI is 10%. Around 10%, and annualized, if we keep on going at this rate, projected out annualized, it should be around 26%. But I think as we keep on going, it'll probably be closer to 10. It'll probably be somewhere between 10 and 26. We'll see by the end of the year. I don't know. Now that we've put this order out a month, it might start going a little bit down, because these numbers are based primarily on when we are running weeklies most of the time, and the weeklies pay more on average over the long term, whereas now we're, I think, a good 45, 46 days out. So we're going to start going to more of a monthly or a month and a half in between collecting premiums. So we'll see how that goes. And until then, yeah, we've collected $648 for the month of May, and now we can just sit back and wait till those options expire, and then we can do it again. So there you go. I'd like to thank you for watching. Like and subscribe if you haven't already, and go out today to myatmm.com and get your free account and start tracking your transactions yourself. Thanks, and I'll see you in the next one.